All right. Well, thank you, Nora, for jumping on. I'll let you introduce yourself, but we're getting ready to talk about a very exciting topic of value creation and emissions management and reporting. Is it just a compliance exercise, or is there a lot of opportunity associated with it? So, Nora, I'll let you introduce yourself, and then we'll kick it off.
Yeah, hi Hampton, and thank you for having me at this podcast. I mean, just to kind of give our audience a brief background, I've been an investor for over 20 years. I spent the last 15 years or so focusing on sustainable investing. I was an activist investor. I also worked with asset owners, worked with asset managers. Over a year ago, I started Canada Advisors, which is an ESG fintech advisory firm. And as you know, Hampton, I've been working with Iconic for just over a year now, I believe, on actually thinking through a lot of these issues in terms of the role of carbon and carbon management and sustainability and so on, and value creation, and in helping companies achieve their strategic, tactical, and operational objectives. So hopefully that's helpful enough as a starting point.
Absolutely, yeah. And you've been a tremendous help to the Iconic Air team, and we've talked a lot about value creation, just as we've been designing the product and talking to customers. So can you speak to what value creation actually means in a business and a sustainability context?
Yeah, that's a great place to start because I believe value creation is one of these buzzwords that a lot of people throw around but don't really
Mhm.
look under the hood. I think in the simplest terms, value creation can be divided in two buckets. The first bucket is net value created. And what I mean net value created, that could mean additional sales or revenues or profits to a specific company. These profits can be tied to the growth in sales of sustainable products or kind of sustainability enabled products or services, or to cost reduction. You might be, for example, having cheaper electricity supply or more reliable water supply, and so on. And all of that flows to the bottom line. So that becomes net value created that is quantifiable and measurable, I would say easily, more or less. The other aspect of value creation is the absence of a negative. That's harder to quantify, but that's critically important. What I mean an absence of a negative is to what degree you're reducing risk, you're potentially eliminating risk. This is hard to quantify. It could be reputational risk, it could be operational risk. And I do believe a lot of sustainability professionals, when it comes to dealing with that second bucket, struggle with quantifying it, but that's absolutely part of the value creation thesis. And it's something, I mean, as we go through our discussion today, maybe
Mhm.
we can really nail down with more detail.
Mhm. Yeah, I think when I think about this absence of a negative, I think a lot about. I mean, the best example I think gets used in business schools a lot is uh, back in the early 2000s when banks were faced with digital banking. It was they saw it as some saw it as a nice to have. It wasn't really a need to have, and then now it's just table stakes. Um, and you lose more business by not having a good digital presence, and it's not always immediately clear, but in 10, 15, 5 years, I think this will be even more than just table stakes. So is it common for sustainability to be viewed through a value creation lens, or is it mostly about compliance and reporting today? What do you see is the conversation around this?
I mean, I'd like to say it's about value creation, but unfortunately, the reality is that a lot of companies still view sustainability as a compliance exercise. And there are a couple of reasons for that. Historically, a lot of what we consider sustainability, which is looking at non-financial factors, whether they're social factor, or environmental factors, or governance factor, were invisible in the way they contribute to value creation. So they were not measured, and we don't have it. It was not ingrained in the culture of companies or in the education and training of business executive to look at these things from a value lens. So a lot of sustainability ended up being a compliance regulatory process where you have to now count certain things and report certain things, but you're not really thinking about it holistically in the sense that this is part of my strategy, this is part of my value creation thesis. This may change as we understand these linkages better going forward, but today I believe a lot of it is driven by compliance and reporting requirements.
Mhm. Yeah, and I imagine a lot of that is a carrot versus stick approach. Like it costs you money to not be compliant. Can you talk about talking about carbon management in particular? Can you talk about some of the revenue opportunities associated with value creation through sustainability and carbon management?
Uh, yeah, there is a lot to say on this front, and if we want to focus maybe specifically on the energy sector where Iconic kind of focuses and operates. I mean, I've seen and I know that there is incredible opportunity for companies in this industry to generate revenue, save money, and basically as well, not just create that value, but also capture that value through sustainability and carbon management. There was a piece of research that was published, I believe, last week by Stanford University and looked at, for example, methane leaks. And they came to the conclusion that the commercial opportunity lost by the energy industry due to involuntary carbon leaks or intentional venting of methane, and sorry, I said carbon leaks, but I mean methane leaks. Um, that commercial opportunity is about $1 billion in lost revenues. So if you were to address these issues, you could potentially receive $1 billion in revenues. It doesn't mean you capture all of it because you still have to invest capital to and processes in order to better manage these emissions. But if you look at the International Energy Agency, did an assessment on methane leaks, and they found out that close to 50% of them can be managed with a positive return on capital. So that
Mm-hmm.
tells me there is at least a $500 million net cash flow opportunity for companies to benefit from better managing their emissions. So that's on the revenue generation, or because that's something that will go now into your stream and into whether you're a midstream company, whether you're upstream company, and you're going to sell it as part of your volumes. But to go a bit further than the revenue opportunity, there are obviously other ways you benefit from carbon management and generate revenues. Um, One of my favorite example is looking at the capital structure of companies and how they could, for example, if they were to establish a decarbonization program and then refinance their debt from conventional debt to sustainability link bonds through sustainability link. I mean, it could be green bonds, but if we're talking about
Mm-hmm.
specifically sustainability link bonds that usually tie to specific objectives around decarbonization, a lot of these companies can get access to a cheaper level of debt. And there was an academic study that was done a couple of years ago on this, and they concluded there was about 29 basis point advantage in refinancing from conventional to sustainability linked bonds. Now, 29 basis point might seem like a small amount, but if you're refinancing $1 billion, we're talking about millions of dollars of savings. So that's another way to create value that is not directly tied to the operation itself, but due to the fact that you have a decarbonization objective. So that's another way to create value. And I'll end up on this third one, which is again harder to measure, but there are these other aspects like talent retention and recruitment, and if you are a responsible operator or not. If you look at the energy sector will lose about 400,000 employees over the next 10 years due to retirement. In order to recruit these people, and they represent about 25% of the workforce, you do need to have a value proposition that is also appealing to the younger generation around you, caring for the environment and for the climate. How do you quantify the benefit of that? It's harder to do, but that's obviously something you need to think about because great companies at the end of the day are about having great people.
Mm-hmm. Yeah, yeah. On that sustainability link bond note, I thought that was particularly interesting. We've talked to a number of operators who've who've taken that approach, and it's not just. It's worth mentioning that sustainability linked bonds, green bonds are typically tied toward green goals, right? But just as and the revenue can typically only be used for what are determined as green purposes. Whereas sustainability bonds, they can be used for general purpose or like general, I can't, general corporate matters, like general purpose matters, whatever the technical term is there. But more than just getting a better rate on the bond, you're able to get more issuers. If you not issuers isn't right. What am I saying? Anyway, you're able to get more competition among lenders, and thus lowering your rate. So you're able to get a better rate, but you're through having more interest in issuing debt to your company. So it really de-risks it in more ways than one. I mean, you don't want to be dependent on one pipeline for your debt financing.
Yeah, I mean, I think you make a great point, Hampton. I just want to emphasize what you are explaining because you're basically talking about accessing a larger pool of capital, which is what
Mm-hmm.
ultimately drive better rates. Because if you
Mm-hmm.
instead of if you're working with a bank syndicate and there are 15 banks there and five which are not going to participate because you don't have a climate target. And we've seen banks like Barclays with very kind of restrictive criteria in terms of how they want to fund oil and gas investments. If you could have that criteria as part of your if you were to respect that criteria, you're going to expand that pool of capital, and then ultimately you could probably get better terms. There's also, I think, an interesting aspect to that I did not mention earlier, but there was a study that was put by Morgan Stanley Institute for Sustainable Investing earlier this year, and they looked at individual investors. They surveyed about 1,000 individual investors around the world, and they specifically asked them as part of some of the questions they looked at whether they would be interested in investing in oil and gas. And over 50% of these investors were ready to invest in oil and gas if these oil and gas companies or energy companies had a viable transition plan. Now, again, there's no quantitative factor here, but if you have more buyers for your stock, then you are likely to have a higher valuation, which means ultimately having a lower cost of capital as you tap the capital markets. So these things, we don't talk about it when we talk about value creation because we always think about it in a linear perspective. I put $1 and I'm going to save $20 in operations. But if you think about it multidimensionally, you're creating value at multiple levels. And that's the way I believe the industry should look at carbon management and also solution providers. And when they do sell their software solutions, they have to unearth all these potential co-benefits from having carbon management.
Mm-hmm. And zooming in on oil and gas again, uh, how would you integrate carbon management into your value? How would an oil and gas operator integrate carbon management into their value creation strategy? And we've seen, and I don't want to get this wrong, but we've seen some instances of like instead of routine flaring, operators are like they're electrifying their fleet. They're using that excess instead of routine flaring. They're using it to power their fleet. Um, so yeah, that's part of carbon management. I mean, what are some ways that you're seeing? How would you integrate carbon management into your value creation strategy if you're an oil and gas company?
I would really start, whether it's an oil and gas company, Hampton or not, I would really start first at the top.
Mm-hmm.
Meaning you have to include sustainability consideration, including carbon management in your corporate and business strategy. I mean, we can go into that a little bit further into what that means, but from there on, then you have to establish proper governance, design proper short-term and long-term carbon kind of reduction incentives. If we're talking about the carbon side, establish a transparent kind of time-bound targets around how you want to manage all of that, and then ultimately tie them to KPI and metrics. And obviously to do all of that, and not because this is an iconic podcast and I'm working with iconic, you do need a robust carbon management platform to understand all of that. I mean, how are you going to start this journey without actually understanding where your emissions are coming from,
Mm-hmm.
where the lowest hanging fruits are? And once you've done that assessment in terms of understanding the return on invested capital when it comes to carbon management, um, depending on the opportunities available to you, it could be upgrading your infrastructure, it could be electrifying certain part of the fleet, it could be capturing methane leaks. There's a host of operational improvements that you can do, but once you kind of run the math on that, then you can start thinking about what to prioritize and how to include it in your strategy. So, for example, if your corporate strategy, let's say your corporate strategy has nothing to do with carbon management. One of the tenet of your corporate strategy is you want to attract the best talent because you understand the value of talent. But because you have that as part of your strategy to create value for your shareholders, maybe you would include a robust climate plan or carbon management plan so you can attract this talent. So that becomes secondary to the original goal. Another example of that is that if you're trying to maximize as part of your strategy return on assets. I mean, there's a threshold. You want to be at one of the best in the industry. Every pipeline, every well, every piece of machinery or infrastructure you have invested in, you want to maximize return on that. Well, because you have that objective, you may say, okay, well, how could I minimize uh, methane leaks? How could I minimize intentional venting so I can maximize sales, I can maximize revenues, and therefore maximize the return on capital? If you think about it that way, this becomes purely business decisions that are executed in part through carbon management. And that's how you integrate it in your strategy rather than I have my strategy here. I'm going to go have a carbon management program here, and I'm going to see how they help each other. And there was a study that was done by IBM Institute of Value where they looked at 5,000, they interviewed 5,000 executives in 22 countries in 22 industries, and they realized that companies that really integrate sustainability in their strategy don't really distinguish between sustainability and business. They are fully integrated in the process from A to Z rather than having it as some kind of add-on. And that's how I would advise executives to think about integrating carbon management in their strategy, both corporate, business, and functional strategies.
Mm-hmm. Yeah, that totally makes sense. I mean, I went to a CFA Institute conference last year on climate risk, and a lot of it centered around this is it's a reporting question. It's a question of good business management, good data management, effectively just knowing having a great. If you're able to demonstrate that you have a great handle on what's coming in and out of your business, then you just look better as a practitioner. So that brings us to the topic of reporting. Big news earlier this month: the SEC passed released its final rule with the final text. I'm reading through, still reading through all 886 pages of light reading, including the footnotes. So how does the new SEC rule tie into this value creation
Uh,
question?
Yeah, that's a good question, and obviously, I think it's something a lot of investors are looking at right now, and companies who are in this sector are looking at. The way I would link it to what we are talking about is that for the most part, the SEC rule focuses on the risk management element of that. So they want companies to look at their climate risks overall. And we're not just talking about emissions and scope one and scope two and all of that. They want to see whether companies are also thinking about physical climate risk, whether they have management structures to identify and manage and mitigate these risks. And ultimately, once you do that and you share that information with your stakeholders, and specifically the investor community in this instance, you're going to give investors clarity on the degree of risk that ties to your business when it comes to climate. So I wouldn't think about it in the terms of value creation in the way we talked about. I mean, it's not the SEC is not coming here and telling you how are you integrating it in strategy in a way where you're maximizing return on invested capital. they mean they want you to talk about governance and strategy and risks in a structure similar to the TCFD that a lot of companies in this industry might be familiar with. But the goal here is really just about surfacing these risks, showing whether you have structures to manage them, and ultimately sharing that information with your investors so they can integrate it in their own assessment on whether this is something they should integrate in their own kind of valuation models and in their conversations with you. So I believe it's this ties to value creation, but it's not the core of value creation.
Mm. And yeah, 90+% of what the Russell 10,000, 1,000, something like that, those companies already produce some kind of sustainability reports. But for a lot of these, but it's not standardized. And there are also still a lot of companies that aren't producing some of these reports. And what do you see as some of the challenges for the spectrum of companies shifting to this standardized reporting? Right now, accelerated filers and large accelerated filers are the only ones required, but I imagine some of the like emerging growth companies, the smaller companies, uh, they're smaller reporting companies. They should have something in place, because if they want to be a potential acquisition target, I mean, you don't want there to be such a disparity between no data and all the data. So, what do you see as some of the challenges for the companies shifting to standardization from kind of a choose your own adventure? We can disclose this, we can not disclose this. Maybe we disclose this year, probably not going to disclose it next year. What do you see as some of the challenges?
I think you put your finger on it, Hampton, when you said about we can disclose this, we can maybe not disclose this. When you're doing this voluntarily, you can pretty much do whatever you want. This year, you want to have a table. Next year, you don't have a table. This year, you want to have this metric. This last year, you had that metric. Obviously, this is not very decision useful for investors. If investors can compare over time and across sectors, then this just becomes a bit of noise. I mean, obviously there is some value if you're trying to, let's say, manage through somebody like disclose through the TCFD or SASB. I mean, there's some level of standardization there, but again, companies have a lot of leeway on how they do it. If it's not standardized according to what, for example, the SEC expects them to do now. So the challenge for, in my opinion, is that you're going to have a bit of a it's almost a quantum leap in terms of the rigor with which you're managing that information, the systems and the processes with which you're collecting and controlling that information and then sharing it has to really be upgraded. Has to be upgraded to a point where it's also compatible with the assurance side of what the SEC expects of you. Because if you look at the SEC rule, they ratchet up the assurance expectation over time. And if there's assurance, I mean, there needs to be an auditable trail in terms of how this data is being put together, and then you can obviously, so you can justify, share, and explain how all this information is being surfaced to investors. So it's a different ballgame. I don't think it is impossible for companies who have already been trying to align with some existing framework, like I alluded to earlier, like the TCFD, but it would still have to be a notch higher, and that could mean a substantial investment in technologies around reporting. It could be in hiring staff that are experienced with that, installing software similar to what Iconic is doing, and helping companies do, and maybe asking for external kind of consultant help or kind of advisory help from environmental advisory firms and so on. For the smaller firms, because I think you kind of alluded to that slightly,
Mm-hmm.
Hampton. I mean, obviously, if they don't have to report according to these very kind of strict norms that a standardized reporting would expect of them, this doesn't mean that they should not be managing for this. And I would like to go to how we started this conversation. At the end of the day, this is not about compliance. This is about how can you create value by understanding your carbon profile. This should be really the driving force of why you look into this. So if you're small or if you're big, at the end of the day, that should be the driving force. Now, if you still don't see the value in that, or you say this is a bit of, it just can't be quantified, or you're convinced somehow with that data that this doesn't matter to you, then you also have to think about the fact that if you are a small company, you're probably part of a supply chain to a larger company. And there are a lot of companies which are subject to Scope 3. That may not be part of the SEC requirement, it's not. But there are companies that will be following the IFRS S2 requirement in many jurisdictions around the world, including Canada, where I am, where they are developing kind of disclosure requirement based on the IFRS recommendations. When you look at the EU CSRD in terms of corporate disclosure. So if you are anywhere in that value chain, then you will probably have to be collecting and measuring this data. So whether you're small, whether you're big, you will have to think about both. You have to think about the
Mhm.
value creation side of it and why you want to do it, and also the compliance aspect, whether you're directly, whether they are directly pertinent to you or indirectly pertinent to you.
Mhm. Yeah, and we talk a lot at Iconic Air about the shift from spreadsheets to this system of what we call a system of intelligence for your carbon emissions, and a lot of that is one-off analyses are so distracting and disruptive, and they lack continuity. So if you have suppliers or customers asking you for these, your, I don't know, your emissions or whatever tied to some products. I mean, it's just so they say they ask you in March, they ask you again in June. Is June going to tie to March? It's just like it lacks continuity and it creates a headache. And it's so much better to just integrate this into the DNA of your company, much like financial reporting. Like you wouldn't do this with financial reporting. At least I would hope not. So you now you have to do it with emissions. And so pivoting, we've touched a bit on capital providers, diving into it deeper and really just more directly. Why do investors care? We've talked about maybe what, like, debt. We've talked a bit about asset managers, but like why do investors care about companies managing their emissions and decarbonizing their operations? What's their side of it?
Yeah, I like where you're going with this, Hampton, because I think it's important to look at this from different vantage points.
Mm-hmm.
So if we look at the investor vantage point, investors care about anything that could ultimately enhance or take away from the value of their investments. Anything that is material to their investment, they care about.
Mm-hmm.
I mean, they're agnostic to what that thing is. I mean, it could be about something related to AI or climate or policy or interest rate. They just look at all that information. So when I look at climate risk, in my opinion, there's no bigger long-term systematic risk to the global economy than climate. And actually, this is not just my view. I mean, a few years ago, Larry Fink, CEO of BlackRock, I mean, the $10 trillion behemoth in terms of asset management, I mean, he said black and white, he said climate risk is investment risk. So when you think about it in these terms, just a very high level, it makes sense why investors care about that. And they care about this risk because when you actually unpack climate risk, you see that it impacts business revenues, profitability, asset values, financial performance. These risks can manifest themselves through the regulatory channel, through the reputational channel, through kind of just the transition risk and what that entails in terms of changing technologies and consumer behaviors and consumer preferences. And this is not to say that there are not also opportunities, because also investors are looking at opportunities, are looking at which companies can thrive in a changing world, a world that is more sustainable, at least a world that is more aware of the damage that might be caused by certain externalities in the way we use natural resources and interact with the environment. So there are also opportunities, and investors want to understand these opportunities. Now, having said all of that, obviously, not all investors are investing in sectors that are as impacted by climate or GHG emission or regulation or transition risk as others. There are some sectors which are more sensitive than others. I would argue the energy sector is at the forefront. Hampton, I was I was investing and trading in oil and gas companies in 2009 and 2010, and I was involved in a lot of kind of activist battles with oil and gas companies in Canada and the United States. And I can tell you, at that point, this was one of the few sectors where you could see that there was a climate risk looming over the horizon. I mean, there were very few sectors who where that was part of the conversation, but I started seeing it in the early 2010s in my conversation with companies, long before other sectors, because you could see that the focus was at that time is about energy, about the emergence of Tesla and electric cars and what that means for this industry. We had the ramp up toward the Paris deal, and again, a lot of focus on the energy industry. So for some sectors like energy, that's a very pertinent risk. And there's also investors which are also focused short term, and some are focused long term. The short term investors maybe don't care. They don't care what happens in 5 years or 10 years. They want to be in and out in 6 months. Maybe they will care less. So I think when companies interact with investors, they may hear a different feedback around how important climate risk is, because investors have different expectations, different goals, different time horizons. So they also have to understand where their investors come from, what their targets are. And sometimes investors, especially short-term investor interest, may not align with a long-term company interest.
Mm.
So that could potentially create difficulty for companies to talk about these issues. But that's, I'm jumping ahead. Maybe we'll touch on that a bit later in the conversation.
Yeah. I think we early on in my tenure in Iconic Air, we spoke to a consultancy that advised private equity firms on sustainability and ESG stuff. And one of the questions there was just, you're buying a company in a world today, and you're selling a company in a world 5 years from now, and what about that company is going to create friction for your ability to sell it? Because say there are four of X type of companies selling in today plus 5 years, you don't want to be the worst of the or the most difficult to sell out of those four, because the market only has so much appetite for these companies. So like the best one's going to get the best price, and then the fourth one's obviously going to get the worst price. So yeah, that seems to be what investors are thinking about. And uh, can you talk about how? So we've got all this data, this reporting. We've mastered the carbon emissions challenge. They've got all the numbers in front of them. How are investors using sustainability data, specifically emissions data?
Yeah, I think there are. So there's not a single obvious answer. There are many
Mm-hmm.
ways investors use sustainability data and emissions data. I mean, the starting point, they may just need it for product development, whether they want to build, specific products that tie to climate or tie to other ESG issues. Maybe they want to sell a low carbon fund or a transition fund or so on. So they want to understand what companies' performance are and where they sit on that spectrum, so they can build product. The second use would be portfolio construction. I mean, you want to construct a portfolio. You may want to have diverse exposure to different sectors, or to different kind of sustainability criteria. Again, not just purely from in a way, a non-financial perspective that you want exposure to sustainable aspects. You may think that sustainability has implications on where the world is going to be 5 years, 10 years from now, and you may want to build a portfolio that's in a way future-proofed. I mean, that's a term that asset managers and owners like to use. To what extent you can future-proof something, I think is debatable, but they would call it future-proof, and they would think about it in their portfolio construction. The third way you would use this data is for risk management. Again, if you think the price of carbon is going to increase materially in the future, and there are companies in certain jurisdictions like Europe and increasingly in Asia where there is also a price on carbon, you may want to understand the risks that these companies are exposed to or may be exposed to. So you can include that in your kind of risk models, in your valuation models. So that becomes the third aspect of it. The fourth aspect is ties to reporting and compliance. If you look at the SFDR in Europe, for example, asset managers have to report on the sustainability profile of the companies and the portfolio companies they hold. So maybe you don't want that information yourself, but you need to report in it for regulatory reasons. You may want that information to report back to your investors if you're an asset manager. So asset owners may ask you to disclose that information. So you're just collecting it for reporting purposes and compliance. And then finally, I would say investors use it for security selection. And when I say security selection, investors are always looking for alpha generation opportunities. So may they look at this information and they may have a thesis and a worldview where certain companies will do better, will do worse if they have X or YZ in terms of their sustainability profile, and they would use that information in distilling their portfolios to understand where to position. So that's really broadly in terms of like the 5 areas where investors use this data. And you can see how broad it is and why investors need that data, because it has different uses across their value chain.
Mm-hmm. And we've talked about this in the past. We also wrote a blog post on it at Iconic Air. What is there a relationship between greenhouse gas emissions and equity valuation, and what does that look like?
So short answer, yes. And one of my favorite studies on this was published by Columbia University and Lazard in 2022. They looked at about 17,000 companies, mostly in the United States and Europe between 2016 and 2020. And they tried to specifically find an answer to this question: if there was a relationship between valuations and GHG emissions and reduction in GHG emissions. And they came to a conclusion that for each 10% reduction in corporate GHG emissions, and we're talking here scope 1 emissions, potentially scope 2 for certain part of that study, but this is not about scope 3. So within scope 1 and 2, if you reduce it by 10%, on average, you would get an uplift of 0.5% in your PE. Now, that's relatively small, but if you look at specific companies in certain geographies, like European large cap, energy, and industrials, the appreciation in PE for each 10% decline or reduction in emissions is between 9 and 18%. So it's an incredible pull. I mean, if you're looking at a company that's trading at $36 in the industrial side, that appreciation would take it to $42 at steady earning because of a growth of its PE ratio from 18 to 20 something. So the benefit here is high, and the reason why that is high because in Europe there's a high price on carbon. So I mean, it just makes sense. I mean, if you are paying now for your carbon and you cannot pass that carbon fully to your client, then your earnings are going to get hit. So that is going to lead to a compression in the multiple investors are ready to pay for your product. But it could also mean that because there's such a high price on carbon, people will be unwilling to buy a product and will try to substitute it with another product. So I think this is just a great example of just the underlying business logic of why there's a relationship. It's not about this is a good thing or a bad thing. It's just basic math, and it just comes across in this study. And it's very. I encourage our listeners to look it up. It's called the financial cost of carbon.
Mm-hmm. Yeah, it's an interesting study. We wrote a blog post on it at Iconic as well. And so we've talked about this at length offline. Some investors may not care about climate or carbon management. I mean, it's a very hot topic today. It's very controversial. How can energy companies commit to decarbonization and net zero without alienating investors who don't care about such issues or it's not high on their priority list?
So I love this question because obviously there's a lot of noise around kind of woke capitalism and anti-ESG and why companies do that. I believe companies should really distance themselves from any moralistic argument of why they do this. They should really focus purely on the business and operational benefits of why they are doing it. And I'm going to give you a very clear example. So starting in 2030, the EU is going to impose a maximum methane intensity threshold for LNG exports into Europe. The European market absorbs about 70% of US LNG exports. As of 2022, the last year for which I have full numbers, that's $33 billion in exports, LNG exports into the European market. As early as 2026, if you are an oil and gas company, you have to start communicating your methane intensity and emission intensity numbers to importers in Europe. Well, if you don't have that information and you want to continue to access that market, well, you can't. And if you can't, you're going to lose access to that market. So if you are investing in a carbon management platform and a decarbonization platform to reduce your methane intensity in order to maintain access to this market, how could any investor come to you and tell you, well, I don't care about these things? If you have an oil and gas investor and your job is to maximize the price and the volume of your oil and gas, and that tool will allow you to do that, then that's exactly what you have to present and bring to the market. And as long as you tie your investment to carbon management and net zero, to the rationale of why you exist as a company to maximize shareholder value, you will absolutely have no problem talking to your investor base. And I think that's where a lot of the industry is going. As a matter of fact, there was a study that was published by the Confidence Board last year around how companies are responding to the anti-ESG push. And more than 60% of them are responding by deepening the understanding of the linkages between the business case and the ESG case. And that's exactly what we have to be doing if we want companies to do the right thing, by first understanding the relationship between the sustainable world and the business world. And trust me, Hampton, in more than 99% of cases, there's complete alignment between the two.
Mhm. Great. Well, Noir, really appreciate you taking the time on this Thursday to talk about value creation and carbon management. Anything that we didn't discuss that you want to add or leave the listeners?
Oh, the only thing I'd like to say is I've had a wonderful year of collaboration with Iconic over last year, Hampton, with
That's right.
you,
It's almost
Kyle,
it's a
James,
1 year
and the rest of the
anniversary
team.
ish.
Yes,
Yeah.
and I'd like to say that you've been my second client, and it's I remain grateful that we've had this relationship since I started Canada. I feel the level of understanding of why this matter from a business standpoint and a sustainability standpoint at Iconic fully aligns with my thinking as well. And I look forward to us working together for many years to come to drive real impact within the oil and gas sector, where I believe we can make a difference and we can help a lot of companies align their business objectives and their sustainability objectives.
Yeah, absolutely. I really enjoyed it as well. And I think at Iconic Air, we take a very pragmatic, operation centric approach to this. And like you said, just aligning business interests with just what we think makes sense. So, again, appreciate you coming on, Noir, and we'll talk soon.
Thank you. It was a real pleasure, Hampton.